something that I wanted to say is that the exercise about the cash flow statement that we saw during the lecture this morning is already uploaded on Moodle. So you can have the Excel file and you can use like an example to solve other exercises. It is in Moodle under the file Excel generating group classes. So you can have a look at that Excel file and use that to try to solve the other exercises at chapter 24. Now, the announcement that I have posted here and also shared with the other participants online is that after having a look at the exercises for the cash flow statement chapter, I recognize the fact that there are too many exercises. Maybe we cannot finish today all of them. So next week we are going to meet each other twice for the tutorial sessions, not Wednesday as previously planned, but on Monday and Friday. The same hours, 2 to 4 in the afternoon. In this way we'll have more time to get them slowly and understand every single exercise, okay? Whereas nothing changes about the lectures in the morning. We will meet each other on Monday, Wednesday, and Friday from 9 to 12 online, of course, for the next week. This is the plan, the revision of the plan. Okay, we can continue, I think, with the tutorial exercises about the cash flow statement. Now, as you have maybe have had the chance to see, the exercises are not all about requiring you to prepare a full cash flow statement. That is a very ambitious purpose and objective for us, to be able to prepare a full cash flow statement that requires a lot of preparations. That means that I'm not going to require you to do that for the exam purposes. In the exam, you will not have an exercise to prepare a full cash flow statement, but you will have similar cases like this one over here. You will be required to calculate 1, 2, or 3 items that are going to be included in the cash flow statement. For example, how much money did you get from customers? Or how much money did you pay to purchase property, plant, and equipment, and so on. So these are very similar to the exercises that you should be able to solve and cover for the exam purposes. By the end of the tutorial today, there are 2 long exercises that require you to prepare full cash flow financial statements. Those exercises are from the textbook, Alexander, that you already have there. And I don't know if we will have time to cover them today, but if we don't, then on Monday we will go through those long exercises. Of course, you'll have time for yourself during the weekend maybe to get the Excel spreadsheet and maybe try for yourself to solve those exercises. Promise, if you follow the formulas in the Excel spreadsheet that I have been sharing with you, it is not difficult to prepare the cash flow statements, okay? So let's continue then with the exercises that are part of the tutorial for today. Now, illustration 1 is, you might think of that as a very unconventional exercise, but actually it is one of my favorites, but also it is a very common exercise included in the exams for certification in the profession. You know that later you can have the title of ACCA or CPA, you have heard of them. Okay, if you go and take the exams, for example, for ACCA or CPA, usually in those exams, there are exercises similar to this one. They do not require you to prepare a cash flow statement. They even don't require you to calculate anything, but they require you to pretty understand very well the impact of each transaction in 2 very important items of financial statements. The one is the net income. The net income is the bottom line of the income statement. So the net income is the difference between revenue and expenditure. The net income or the profit for the year is reported at the end of the income statement, and it is one of the Whereas the other one is cash flows from operations. Cash flows from operations is the first section in the cash flow statement. It is also very important. As we have mentioned previously, net income and cash flows from operation are similar to each other, with maybe the only difference between them being the accounting concept that we apply for each of them. That is, net income is based on the accrual accounting concept, and the cash flows from operation is based in the cash accounting concept. That is like the main difference between both of them. Of course, they are part of different financial statements, but also they are calculated being based on different accounting methods and principles, okay? Now, what we are required to do is that for a simple transaction, we have 7 of them over here, we have to state if this transaction will have any impact on net income or cash flows from operations, but not really measuring the impact numerically or with values, certain values, but just to state if it will be increased or decreased, or no changes there. If it is going to be increased, you put a plus. For decreases, you put a minus, and 0 for no change. For example, I will show how to do the first one, and then we can discuss together about the other transactions. Now, something that you have to keep in mind is this. You are required to measure the immediate effect of the transaction on these measures or indicators. You are not supposed to think that, oh, okay, I do this thing now, but this thing will bring this other thing 2 months after that. No, we don't want to think in a cumulative way about transactions. Of course, everything that we do will have consequences. Don't think about that, think only about what it brings right now. So what is the direct impact of every move that we do there, of every transaction, okay? So first of all, it is selling financial investments at a higher price than their carrying amount. Now, be advised that this is a financial investment. It is not investment in trading security. We mentioned that if we buy short-term investments less than 3 months, they are part of operating activities. But if we buy financial investments, that is, if we buy securities for more than 3 months, that is part of the cash flows from investing, okay? Having said that, now we are selling these investments at a price that is higher than their carrying amount. Do we have any impact in the net income for the period? At the moment of selling them, and which will be the impact? If we are selling at a higher price than we purchased previously, this means that I will have, tell me if you don't agree with me, this means that I will have a gain on sale of investment. Having a gain on sale of investment increases the overall gain or profit for the company. That means that this transaction will have a positive effect on net income. Each time that I sell investments with a value higher than the cost of purchasing them, I am generating gains, and this increases the net income, okay? Questions? Good. I'm not continuing, just be very careful what the figure of the income is here. If I would say not net income, but for example, gross profit, would it bring any change? If it was not net income, but it was gross profit, would selling financial investments at a higher price than carrying amount would bring anything or any change, any impact to the gross profit?
No.
Why not?
Because gross profit is the difference between revenue and the cost of sales. And so it's the financial income.
Gross profit is the difference between revenue and cost of sales, whereas the gain from financial investment is somewhere below that. So nothing changes in the gross profit. Why did I say that? Be careful what line of income we are putting there. Sometimes I don't change the transactions at all in the exam. I just change the level of the profit, or I do it not CFO but CFI, and nothing changes in the transaction, but still it is not the same thing. So be careful what we are trying to measure here. Now let's continue with our discussion. If we sell at a gain, of course this will increase our net income as we argued. But what about the cash flows from investments, from operations? Is there any effect on that?
No.
Very good. Seems like you got it. So zero impact on cash flows from operations. Why?
Because it's an investment.
Because it is an investment. It will impact the cash flows eventually, but not those under the operating activities, but the cash flows from investing activities. That's another section of the cash flow statement. Okay? Good. I think you got it. So selling merchandise on credit. Selling to customers, not in cash, but on credit. That means that I will have trade receivables. Now, half of the trade receivables will be received or will be collected in the current reporting period, and half of that in the next period. Is net income impacted from this transaction?
Yes.
Plus, minus?
Plus.
Of course, okay, good. What about the cash flows from operations? Why?
Positive.
Why?
Because part of the trade.
Because a part of the trade receivables has been collected. Okay, it's only half of that, but still, I'm receiving some money. Even if I received only €1, that would be a plus over here because I'm receiving something, okay? We are collecting half of the receivables. Good. Reclassification of trade receivables at your end from non-current to current. Will that impact the net income at all? No impact here. Everything goes from one section of the statement of financial position to the other one. So this is a movement only within one statement, no effect neither in the income statement, and that is the net income, nor in the cash flow statement, and that is CFO. So no impact. Why? Because it is a simple movement within the primary financial statement. Maybe you remember what I told you yesterday. There is a kind of chronology where the transactions give their effects. The first statement ever where they are reflected is the statement of financial position. And if a transaction stays in there, no effect into the other statements. Paying principal of a long-term loan.
No impact.
No interest, just principal. Okay, as Gloria said, no impact on net income. Why? We are paying only the principal of the loan, not the interest. If I am paying the interest, that would be interest expenditure, and as I pay expenses, I agree, I have lower net income. But we are just repaying the principal. What is the principal amount, by the way? Because I'm always talking as if you know what I'm talking about, so sometimes maybe we'll be clear about that. What is the principal amount of a loan or a debt? Yes?
It's that fixed part that I pay each year until I go to pay all the loan even the first year I receive.
It may have different names like face value of the loan or contract value or nominal value or the principal value. It means the base amount that you are borrowing, but when you give that loan back, you need to pay the base amount, the principal amount, but also the interest. Now you are repaying back only the principal, no interest there, and that means that there is no expenditure attached, no impact in the net income. What about the cash flows from operating activities? No impact. Why? I'm paying some money, so it should be something there. Of course it is. There are cash outflows involved, but they are going to be classified and reported under the cash flows from financing activities, as we are repaying loans and debts, okay? So as a CFO, 0. Receiving cash from customers. Now this is easy. In net income, 0. Why? I'm receiving some cash, by the way.
We have already
Why is
recorded.
0?
We have already recorded previously.
Good. We have recorded as a revenue in the moment when we realized the revenue, when we sold the merchandise or the inventory. Now I'm just receiving this money. That means that I will close the account of the trade receivables and increase cash for the moment. No revenue involved. So 0 impact on net income in the moments of collection. But CFO, any impact on that?
Positive.
Good. Recording cost of goods sold. Net income?
Negative.
Yes, I record cost of sales. Negative impact. Now, somebody here might overthink the situation. If it was me, I would think like, okay, when we record cost of goods sold, according to the matching principle, we have also to record the revenue from sales, right? So usually the revenue are higher than cost of goods sold, so the impact on net income is positive. If I was you, I would overthink the situation, but again, I told you, do not go beyond this one transaction. Don't think what else it will bring later. Just think about this one. So just recording cost of goods sold. On the accounting point of view, accounting entry, it will be debiting the cost of goods sold and crediting the inventory account. So then we have only one expenditure account goes up. This makes a negative impact on net income. What about cash flows from operations? Any cash involved there?
Zero.
Not yet. Okay. Purchasing inventory on credit. Any impact on net income?
Zero.
Yes. No.
It's credit. Zero.
I was looking because this is something that I thought I brought as an example this morning. When we purchase inventory but we have not sold this inventory, it is a kind of investment to us. It will stay in the balance sheet until it is sold. That is when we purchase inventory, no impact in the net income. 0 impact. What about the cash flows from operations?
Money.
Negative.
As this
Negative.
purchase is on credit, that means that we have not paid anything,
Zero.
we have not received anything, so 0
Okay.
impact on cash flows from operations. Did you understand this exercise? I think it's a very, not only very beautiful, but very useful exercise for you to make you think how each transaction has an impact in very important items of financial statements. It's very useful to think, not just to make calculations, but really think about that. Okay. In case there is no question, I'd like to jump to illustration 2. It's a very interesting one to discuss. There are two entities, A and B, or X and Y. You may call them like that, but I put there A and B. Both of them report the following cumulative cash flows. So these are cumulative for 3 periods. Okay? And the amounts are in millions of dollars. Entity A and Entity B. Now we have cash flows from operating activities, investing activities, and financing activities. Now, one of the entities is eBay, the eBay company that we know. They focus in online retail, and in this time span that we are talking about, they have had an annual growth. You can see annual growth really very high, like more than 300%. The other entity is TJX Corporation. They engage in retail, global retail company. And for the 3 years time span, they have reported a growth of only about 39%. So something between 10 and 13% per year. Now, which one is which? How can we say that? And also, taking advantage of this exercise, I would also like to explain something new, not only solve the exercise. But if you have any idea, just tell me and then we continue discussing. No ideas, even in the chat? So we have a company which is obviously in the growth stage. You remember the 4 stages of the life cycle of companies?
Initial.
Okay, good. Let's start with discussing about them. Okay, we have some answers in the chat. So eBay is company A because it is growing a lot. Mhm. And I agree with that. Now, if you have any other idea before I continue? Okay. How we can make a generalization of the situation out of this, not just for these 2 companies, but to explain and to learn something new. Okay, let us discuss together. It's something really very logical and will make us think a lot. You know that the life cycle of companies is including 4 different stages, yes. The first one is entry in the market. The second one is growth. The third one is maturity, or being at a constant stable rate of growing. And then the fourth one is decline, or liquidation of the company, going out of the market. The company closes its life cycle. Now, it depends on different sectors and different kinds of activities how long this life cycle usually lasts. But for the modern companies, we are used to see shorter and shorter life cycles. That means that the companies do not take anymore like 10 years to jump from entry to maturity. One company, within 3 years, they can jump from entry, they pass the growth stage, and they are fully mature by 3rd or 4th year of their life cycle. Now, what is the connection between where they are in their growth or life cycle stage and the state of the cash flows in the cash flow statement? This will help us to analyze companies better. Now, imagine that you have a company in the entry stage. This company has just been created, it has been newly introduced in the market. We still do not have many customers. Our products are new to the market. And what do you think the cash flow from operations, how high or how low will it be? Usually for a company in the entry stage in its life cycle, the cash flows from operations usually is negative because the companies are not generating a lot of cash from customers, but still they have to pay their suppliers, their salaries, and their usual bills. So usually you will recognize a company which is new to the market, which is in the entry stage, because this company will usually have a negative cash flow from operations. Why? Because it is a new company. It still doesn't have a lot of customers. Okay? What about the cash flows from investing? Remember that cash flow from investing represents the difference between how much I pay for purchasing new equipment and how much I get from selling existing equipment. Now, a new company does have nothing to sell here. They just buy. They just buy new equipment, new buildings, new plant, property, and equipment, and so on. So the cash flow from investing activities, I agree, will be negative. What about cash flows from financing activities? Where we have to find money somewhere, right? And we find money under the financing agreement. How is that? Usually the companies in the entry stage, they find financing through 2 main instruments. One is issuing shares and raising the equity funds or equity financing. And the other way of raising capital is to issue bonds, debentures, or to take loans or debts in the bank. So either of this way or both of them combined, in the entry stage, usually a company has more cash inflows from having new debts or issuing new shares than it has cash outflows to repay these debts or loans, okay? Now, we are passed through the entry stage. Now we are growing in the market. What happens to the cash flows from operations? What happens here? Does it become positive immediately? First, it grows, it becomes less negative, and then it becomes positive by the end, middle or end of the growth stage, okay? So we are growing, our products are becoming more popular, we are receiving more money from customers, so cash flow from operations is becoming less negative until finally it becomes positive. Good. What about the cash flows from investing? Are they positive or negative in this stage? We have some very shy suggestions. Yes, it is negative. Usually the companies, when they are growing, usually they start to expand their operations. That means they start to buy a second building. They start to open secondary point of sales. They start to buy new plants and machineries. That means that in the growth stage, they are continuing to invest in new fixed assets, and therefore the cash flows from investing is negative. What about the cash flows from financing activities?
Still positive.
Definitely positive. This is the moment when usually the companies, after receiving the first loan from a bank, usually after 5 years in the growth stage, they go to the same bank and they usually ask for a renovation of the loan or for a second loan to justify their growth, because they need to grow and expand in the market. Now we passed that stage, and now finally we are at our full capacity. We are mature in our established in our market. What about the cash flows from operations that is positive and also very high at the same time? It is at the maximum possible. We gather many funds from our customers usually, as we continue to pay our bills and invoices, but still we use, in the maturity stage, we usually use the cash flows from operations to support the other two categories, investing and financing. That means that when I come at the investing cash flows, they are going to be negative again. Why? Aren't we at maturity? Maybe we don't need to invest that much anymore. Why still we have negative cash flows from investing activities? And sometimes not low, they are very high. Even for mature companies. Why is that so?
Buy some primary products to produce.
This is cash flows from investing, so it represents buying or purchasing equipment, machinery. Usually the mature companies have been out there in the market for 10 or 15 years, so this is the exact time for them to replace the technology. Technology has changed. There are newer machineries out there, they have to replace them. So this is like the perfect moment. Now, as you buy advanced technological equipment that cost a lot, you cannot take back as much cash from selling these existing outdated machineries. And that's why the cash flows from investing keeps being negative and sometimes very high in a negative amount. What about the cash flows from financing activities? Well, it may be negative, it may be positive. In the maturity stage, remember that for some very successful companies, the maturity stage may last for decades. Consider Coca-Cola company, they are in the maturity for 100 years already, for a century, because they keep introducing new products. And so the life cycle of the product extends over the life cycle of the company, you know, all of that. But this means that if it is such a long period of time, this means that sometimes you have years with negative cash flows from financing. That means that you need to repay back the loans that you to have received, and sometimes you need cash to finance your activities. That also depends on the year how the cash flows from operations will be. Let me give you a brief example. 2020 was not a very good year for most companies. The CFOs really suffered the decline in demand from customers, at least for some of the companies, not for all of them. Now, for these companies, 2020 was a typical year, even for those companies in the maturity stage, was a typical year when the CFO was not enough to finance the other two activities, so they needed to take loans and debts. Therefore, the cash flow from financing would be positive, representing many cash or much cash coming in the company. Well, if we go in 2021 or 2022, hopefully these companies will generate more cash flows to be able to repay the loans that they are taking. So it's like a cycle. They will take loans, they will pay them back, taking other loans, paying them back again, and so on. Remember, the maturity stage may last many years. Finally, decline is here. We have to go out of the market. What happens with the cash flows?
Maybe first positive and
Okay.
then
It declines slowly and then at faster rates until it becomes negative. By the end of the life of the company, the cash flows from operations becomes negative. Nobody wants to buy the products anymore, but still we have to pay some bills, so it becomes negative. What about the cash flows from investing activities?
positive.
Finally, this is the only stage in the life cycle when the cash flows from investing can be positive. And actually what really happens with these companies is that as they are going out of the market, they start liquidating all their assets. They sell their equipments and use this money, the money that they take from disposal of assets, they use to what?
Pay loans.
To repay any remaining debt. So negative, it's going to be the sign of the cash flows from financing. Now, remember this pattern or behavior of every cash flow under three activities when you think of companies and analyze them. Look with these eyes at your companies that you are analyzing. What stage are they? I bet they are all in the maturity stage, but look at their cash flows. What do these cash flows say about these companies? Now let's go back to our two companies over here. Obviously, eBay is in the growth stage, right? Do you agree with me? So eBay company is in the growth stage, and the other company, TJ Corporation, is in the maturity stage. Okay, maturity stage over here. Having said that, have a look at the growth stage. Now, what we expect here, it is a very, for this kind of company, it is a very high amount of cash flows from investing in the negative side, of course, but this means that these companies are expanding in the market, and this actually fits the description of company A. Cash flows, of course, but cash flows from investing, they are really negative, and moreover, you can see that we have positive cash flows from financing, something that we expect from companies in the growth stage. So eBay is company A. Why? It fits the description or the feature, the profile of the cash flows of a company in the growth stage. Positive cash flows from financing and considerably negative cash flows from investing activities. Whereas the other company, TJ Corporation, which should be the big company over here, they are in a maturity stage, and you see they fit the profile that we explained and introduced. Companies in the maturity stage generate enough funds from cash flows from operation to fund or finance the other two activities, to finance for other investments that they need, and also to fund and finance the liquidation of several existing debts and loans. Okay? Now, it took us some time to explain this beyond the exercise itself, but I think that it was worth it to know something more about the pattern and behavior of cash flows during the life cycle stages. Any questions for that? Okay, good. Let's go on with the third illustration. That should be an easy one, I hope. We have this data. The company has recorded the following in year 1. Okay. Sandoriano has commented in the chat, A is eBay, okay, it's not normal to have a cash flow positive. Actually it is, especially in the growth stage. It is very typical to have a positive cash flow because these companies in the growth stage, as they are expanding, they usually ask for many loans or usually issue many new shares and bonds in the market. So usually you will find that companies in the growth stage are hugely financed through outside funds, and usually it is the growth stage when the companies go and are incorporated. They go public and issue shares in the market, which is the reason simply to have more financing, to have more funds. Okay, now that we responded to that, thank you for the comments. I think that you had the time to look at this exercise. Any idea? Any idea here? Read it for 1 minute. This is one of those simple questions that would be a pity for me to answer. You could use the chance to leave a good impression of me. Net cash flow from investing activities. So let's be clear. What we are looking for here is this one. Not operating, not financing, not net cash flow, the sum of them. Just this one. So you may have a lot of information. Not all of them has to do with cash flow from investing. So first of all, let's filter and let's put some criteria to take out the relevant information. Proceeds from issuance of long-term debt. That has nothing to do with what we are looking for because it's part of cash flows from financing. So nothing important there. Purchase of equipment. Okay, that's something that I will consider. So let's underline that. Loss of sale of equipment.
Nothing.
Okay. Actually, not part, yes. Question?
Why is the first point financing activity and not investing?
Because it's a long-term debt.
Because it is issuance of long-term debt, this means that this is a debt that we are issuing. How can I explain it?
It's
It's
a
not a
long-term.
debt that we are
3 months. It's not like 3 months.
giving to other parties. It's a debt that we are receiving. We issue bonds or securities that are credit. I don't know what other explanation. What is your ambiguity over there? Why are you confused? Maybe if you explain your position, I can better explain mine.
Because if you issue a loan, for example, it's not investing activities.
You proceed is you buy from other companies investing. You
I'm not
issue.
getting it, sorry. Once again?
She asked like if you issue long-term debt, isn't it investing?
because if we issue debt, this means that I'm collecting money.
It's
I need
financial,
money to
yeah.
get financed. If I have money and I don't need to get any more money, I would not issue debt. I would invest. That would be investment. This means issuing debt means that I'm trying to collect money to finance the activity. Maybe you are confused from the word issue. I don't know. Yeah? But still, it is a financing. Maybe I'm not understanding the whole story there. Do you all have the same confusion? Do you all have, okay. Okay. So, we can continue. Again, when we issue some debt, this means that we are trying to provide financing for ourselves or our company. If we have enough money and we don't need to collect money through financing or fundraising, we would not issue any debt. Okay. Again, loss on sale of equipment. At first sight, you think that, oh, equipment, that is investing. Careful. Loss on sale, actually it's not a cash flow, nonetheless. It's only an adjustment under cash flows from operations, and this is why I am emphasizing that. So loss on sale is not a cash flow. It is an adjustment under the indirect method only. Please remember this. It's not a cash flow. Proceeds from sale of equipment. Proceeds. Do you understand this word? Okay. Yes, this is a cash flow from investing. Equity in earnings of affiliates. Affiliates are investments. Affiliates are okay. Have you discussed the standard covering the equity method of recognizing investments in affiliates and joint ventures? Did you cover that in the first part of the course?
joint venture是属，但是
Yes or no? I need to be clear because it doesn't impact here.
Only mentioned about
Only mentioned, okay. Now, if this is considered an affiliate, not a simple investment, it will be included in the equity section of the balance sheet. As it's going to be included in the equity section and not as a pure investment, this is a cash flow from financing activity and not from investing activity. Usually an affiliate means that we are investing more than 20% in the shares of another company, from 20% to 50%. Above 50%, it is a subsidiary and we are going to be required to consolidate the financial statements. Below 20% is a simple investment and you can show that in the current or non-current assets in the balance sheet. But if it is between 20 and 50%, then you have to account the affiliate according to a method in accounting known as equity method, under which you record the earnings of the affiliates as increases in your equity. That means that this part of financial statement, cash flow statement under financial activities, not investing. Okay, the word affiliate is the key word here. It's not saying investment, and therefore it is part of financing for companies. Okay, so if we consider purchase of equipment 200 and proceeds from sale of equipment 120, that means that this is the right answer over here. Cash flows from investing activity are equal with cash inflows from sale of PPE minus cash outflows from purchase of PPE. That is equal with 120 euro less 200,000 equal with minus 80,000. Okay?
Professor, can I ask the proceeds from sales of equipment? Equipment is like an operating asset, so isn't it something like operating cash flow? Proceeds from sales of equipment, because equipment is an asset we use normally.
Okay. We have a question here in the class. Maybe you all want to hear that. Your friend is asking if we have sale of equipment and equipment are operating assets, why don't we include the proceeds from sale of equipment in the operating activity? Again, her argument is that actually equipment, property, plant and equipment are operating assets after all. Who is able to respond to that? And I have to mention that's a very good question. Did you make the distinction between operating assets and non-operating assets? Financing, investing assets? Remember that we are talking here about operating and investing activities, not operating and investing assets. Okay, maybe you, what can I say? Operating assets are assets that usually don't meet the criteria of being classified as financial assets. What are financial assets or financial instruments? Usually are instruments or assets that will be converted to cash in the near future. That is usually cash and cash equivalents and accounts receivable. These are considered financial assets, not to be confused with operating assets that we do not expect to convert in cash in the normal procedures, normal operations. But that may happen when I replace a plant or property or equipment, okay? Now don't confuse. When we classify the assets in operating and financial, that happens under the IFRS 9 financial instruments. Here we are under IS 7 and we are talking about the classification of activities and not assets. And we are dividing or having some distinction between operating, investing, and financing activities. And basically, please remember, operating activity will be whatever is not considered investing or financing. That means investing is everything that will change your investment structure. It doesn't say operating or non-operating structure, but investing structure. And investing is related to tangible assets, intangible assets, and financial assets. So basically non-current assets. Whereas the financing activity will include everything that will impact the structure of financing. That is loans, short-term or long-term, and equity. Everything that is not investing or financing, it will be operating. Just keep this in mind. So again, equipment are operating assets, but under IS 7 are considered within the classification of investing activities. Because when we change the amount and the number of equipment, we are changing the structure of investments that we are doing. Maybe that makes sense? Okay. Sorry about that. Okay, let's continue. That was, I would consider that a very simple question, right? So let's continue with the other one. Again, a very short example. On 31st of December, a company issued a £30,000 180-day note at 8% and used the cash received to pay for inventory. It also issued 110 long-term debt at 11% annually, using the cash received to pay for new equipment. Which of the following most accurately reflects the combined effect of both transactions under IFRS, IS 7? 1 or 2 minutes to think about that, and then we discuss. you are thinking or maybe discussing with each other, I'm starting to have some hints written there. If we issue 180 days note, that means that this is a loan, a short-term loan, 8%, but still that is cash flows from financing, okay? We generate some money and we use this money to purchase inventory. Purchasing inventory is cash flows from operations, right? Then we issue another loan. That's again cash flows from financing. The money that is generated from this long-term loan, we use to pay for equipment. Now, it's pretty obvious. Which is the net effect? The first one, it can't be true because operations unchanged, that's not true. We see that CFO here has been impacted, okay, so that's not true. What about cash flows from financing? Have they been increased by 110? No, it has been an increase by 30,000 plus 110,000, so this is not true again. What about the operations? Have they been decreased by 30,000? Yes. When we pay for the inventory, 30,000, this means that the cash flows from operations will be decreased with 30,000, and that is the correct, here, that is the correct alternative. Okay, this is also the explanation. Any second thoughts on that? Okay, good. Now, this is for true, I'm leaving this up to you. I'm not intervening at all until you have an idea for yourself. Again, it's not difficult. Okay, maybe you answered before I mentioned the critical data there. Remember, we are prepaying. That means that in this period we are paying in advance for some other expenditure in future, but I'm paying now. And also, some payables have been decreased. How do we reduce our liabilities? Usually, as I said, not by magic, but by paying them. So again, this involves more payments now. Okay? So I think you have already calculated that. Mm-hmm. I'm waiting for someone to take the floor, please.
Maybe we can do 20 million and
Yes.
less the prepaid interest expense of 4 million.
Okay. So, just to complement what you are saying, that's true, of course. remember what we showed this morning, that in every time that you have to calculate what you have paid somewhere, anywhere, you start with the item in the income statement. What is the expenses for that item? And then you add the adjustments that are reflected in the statement of financial position. So start with operating expenses. These are 30 million over here, okay? But beside that, you have also paid, what else?
I have the prepaid insurance expense.
Mm-hmm.
And
What
then
else?
I have to add the decreasing payable of 7 million.
Okay, so it is 30 million plus 4 million in prepaid that we have performed this period, plus another 7 million. That is equal with $41 million paid this period. Does that make sense? So of course we start with the expenditure, but then we take into account what has happened with the amounts in the statement of financial position. In this case, we have two different items, one of which is prepaid and the other is payable. And we have to think, now if we increase the prepaid expenditure, this means that I'm paying more now, it should be with a plus. If we decrease the payables, again this means that I'm paying now, again plus. Now if it would be, just for a moment assume, prepaid insurance expenses decreased by 4 million, this decrease in prepaid expenses would be with a minus. Do you get that? No. Okay, be careful because the exercise in the example will not be exactly like this. It can very good be decreased in prepaid expenses. So I just want to be sure that you understand that. Another thing that I may add here that maybe will help you, remember the second type of adjustments in the indirect method. Okay? The second type of adjustments increase in current operating assets. Whenever you have an increase in an asset, means that we have to deduct them. Plus decreases in current operating assets. Every time we have decreases in current operating liabilities, and in case we have increases in current operating liabilities, they would be considered with a plus. The second type of adjustments in the indirect method is the basis on which we decided the signs over here, okay? Increasing prepaid expenses is operating assets. Every time it increases, sorry, this is my mistake here. Every time we increase an operating asset, we have a minus in the indirect method, but this is the direct method what we are trying to do over here. That's why the signs do not correspond for the assets. Whereas for the liabilities, of course, we have to decrease, we have to add the decreases in current liabilities because this is the direct method. Okay. It was something that I mentioned not in the right place, not in the right time, but still it's a reinforcement what we have learned. This is direct method, this is indirect method. A little bit later we'll see an exercise when we have to jump from one method to the other, and we will see also there that an adjustment in the indirect method doesn't necessarily have the same sign with that of the direct method. So it's good if we also have it here, just as a reminder for ourselves. So this is the right alternative, and I'm putting that in bold. Okay, illustration 6, I understand that it requires some effort to deal with that. So maybe I will give you 2 or 3 minutes to think how to treat illustration 6 in case you have not previously thought anything of that, and then we'll cover that together. I agree it is slightly more complicated than the first ones, but it is very similar with what we covered in our Excel spreadsheet this morning. We need to calculate the purchase of new equipment. Remember that we delivered a formula or an equation how to do that. Basically, what we are required to calculate is how much or how large are the proceeds from sale of property, plant, and equipment. Okay? Any idea how to do that? Okay, you can start the calculations until 2-3 minutes, and then we will discuss that together. You just can say up to which point did you arrive. I'm giving a hint for the others, so you will not continue just looking at the exercise. Remember that we have a formula like gain on sale of a property, whatever. This is an equipment in this case. Gain on sale of equipment is equal to the market value of that equipment, and the market value is exactly what I'm looking for here, receipts from sale, less carrying value of equipment. So we have this formula. How do you know that? It's something that you should have studied in your previous courses in accounting. Now we have the gain of sale. Yes, we have that. The gain of sale is 12 million. Do we have the carrying value of equipment? No, we don't have that, so we have to calculate the carrying value so we can find out how much is the market value or the proceeds from sale. How much did the company receive from selling this equipment? So again, this is what is missing. I'm putting that in red color. This is what I need to calculate. Gain on sale, I have that, it is 12 million. Try to find this one here, carrying value of equipment that is being sold. If you find that, it's very easy. 2 minutes for that, not more. Will you allow me to give you another hint? Or not? calculate carrying value of equipment. So that means the value that this equipment has in our accounting books. In the fair value model, this is very simple because the carrying value of any equipment is exactly the fair value or the market value. And under that model, I was supposed not to have a loss or a gain, but this is not the fair value model, this is the amortized cost model. That means that the carrying value of any equipment, of any asset, is the difference between historical cost so the difference between historical cost and accumulated depreciation. Okay? Good. Now, to calculate the carrying value of equipment, it's very obvious that I need to know what is the historical cost of this equipment that I'm being sold right now, and what is the accumulated depreciation of this exact equipment. Okay. So you can continue trying to calculate any result. Any idea? Do I know any of this? What is the historical cost of equipment? Or the accumulated depreciation of this equipment? Again, I don't want to know the historical cost of all the equipments. These are all the equipments. I'm selling only one of them. This is the accumulated depreciation of all the equipments. I'm selling only one of them. So what I have here is the balance sheet balances or items, and I may have 1,000 different equipments. I want to know only one of them. What is the historical cost of this piece of equipment that I sold during the year? Okay, not all of the equipments. Okay. This is the X, the missing amount. And this is Y, also a missing amount. I need to calculate both of them. Okay? Well, how can we do that? Anyone that has taken notes during the lecture yesterday and today to help us to solve the dilemma here? Anyone?
但15是新的还是这个呀？感觉不知道它那个信息到底。
Again, these two equations, these two formulas, yes, they may be actually. Sophia, yes, they may be 6 and 2, but I need to do the calculations now, so maybe you are right, thank you. In the meantime, maybe you can write in the chat how did you come up with those figures. Maybe you know a simpler way than me to present the solution, something that your friends can understand better than my solution.
15 minus 9 million.
15 minus 9, why?
Because
15.
the capital expenditure and we have the change of the equipment is 9, so have the difference.
Okay, good. Now we have what is being explained by Sophia, thank you. In the chat, you can also look at that, but in order to have a very consistent way of solving exercises, sorry that will take a little bit more time than your friends, I'm going to repeat the same formula that we introduced in the Excel illustration that we covered today. Remember what we said about the equipments? We said that the equipment opening balance, if we add purchases of new equipment, sometimes that is the capital expenditure that we mentioned, and if we subtract, if we deduct the equipment sold at cost. Then we have equipment at their closing balance. Now again, this is a very simple formula over here. If we take the equipment, their opening balance, and if we add the increases, in our example, the increases do not come from fair value or do not come from reclassification. The increases come only from purchases of new equipment. And if we deduct the equipment sold at their cost, so this is the X that I'm trying to calculate over here, I will be left with equipment with their closing balance. Let's see what we have and don't have in this equation. What is the opening balance of the equipment? It's everything here. The opening balance is 100 million and the closing balance is 109 million, right? So the opening balance 100. Purchase of new equipment, yes, capital expenditure is here. So plus purchases, 15. I don't know, this is the unknown figure for me. X for the moment. What is the closing balance? Remember, it is 109. So in order to calculate the 6 over here, it is simple, 100 plus 15 less 109. That means that the equipment sold are with a value of 6. As your friend already proposed, okay? But we just showed it in a little longer method just to know how to properly do the calculations, even in another example if you might have another one later, okay? So equipment, we add increases, we deduct decreases from possible reasons, and then we are left with the closing balance. Now, all the equipment that we have in our factory, usually we increase them by purchasing new equipment and we decrease by selling the existing one. We know the value of the purchases that we have made, the capital expenditure. The only thing that we didn't know was how much costed the one piece of equipment that I sold. In order for the accounting or the account of equipment to be balanced is to credit this account with a value of 6. So it will be in balance. Again, I do not want to open the T amounts, it will complicate things for you, so maybe it's better to just look at the formula that you have here. Questions so far? Can you do the same thing logically to calculate accumulated depreciation, the Y that is missing over here? Okay, so regarding the accumulated depreciation, remember from accounting courses, accumulated depreciation is a contra asset account. Usually we compare that to the historical cost less accumulated depreciation, and we have the carrying value. Now, related to the current calculations that we are trying to do, we have an opening balance of 30 million in accumulated depreciation and a closing balance of 36 million, right? So I'm putting them over here. 30 and 36. Good. We know that the depreciation expenditure for the current year is 8 million. Okay. Now something is missing because 30 plus 8, it's not 36. It should be 38. So what is missing? We have to add under the Y figure. What is the name for this amount?
The depreciation of the assets we sold.
Okay, so the accumulated depreciation of the equipment that we are selling, this is the missing value over here. Because obviously 30 plus 8 is not equal to 36. So what is missing here is a figure of 2. Calculated as 30 plus 8 plus 36. Okay, this is exactly what your friend suggested in the chat, but not calculated as a shortcut, but with proper formulas over there. Now that we know how much is the historical cost of the equipment that we sold and the accumulated depreciation of this piece of equipment, we can substitute the figures over here. So the historical cost of equipment is 6 millions, plus the accumulated depreciation of this piece of equipment, which is 2, we calculated each of them here below. Then we are left with the carrying value of the equipment equal to $4 million. Good. Now that we know the carrying value of equipment, this is the missing amount in the above equation, above formula, we go back there again. What was the gain on sale of this piece of equipment? Again, the gain on sale was 12 million. And this will be equal with the market value for us, this is something that we still need to calculate, less the carrying value that we just found out it is equal to 4 million. That means that the market value of proceeds from sale that we need to calculate are equal to 12 million plus 4, 16 million. Okay. So alternative B is the exact one over here. I strongly encourage you to go over this exercise again. It has been a very similar one in the past last year. I'm not saying that it will be again, okay? We are not repeating the same exercises. But if you are not sitting in this session now in November, but in another session in January or somewhere in the future, maybe you have the similar exercise like this. So please pay attention to this, okay? And even if it is not only for our course, even if it is for some tests that you need to do in practice, actually all these questions, I've been taking from the test question of ACCA exams. If you want to take, or if you want to be certified as a professional accountant in the profession, one of the most respected titles internationally is that of ACCA. And there are several exams that you need to take. One of the exams, of course, is financial reporting. And all these exercises I've been taking from their exam. So this is what you expect to find when you go in the profession. Okay. We have illustration 7. You can have a look at that. So we have the following information, and we are required to calculate the total adjustments that we need to make to the net income in order to derive operating cash flow or CFO. Now the total adjustments are 2 kinds. The first adjustments involve non-monetary items. The second adjustments involve working capital items changes. So have a look over here. What do we have? So we can decide for ourselves. 2 minutes for you to try and then we solve together. You can check your notes, we have everything there when we try to solve the exercise.
depreciation 提出去，
嗯，
然后再就是其他那几个 change 相加呗，
对，
那就是30
加7
减7吧，还是加7？
net income
啊，加7。然后 receivable 是我们
先把
钱是变多了，应收的变多了，所以我们没收到，所以应该是减15。
对，
然后 inventory 是下路
没有影响吧？
减3加3，然后
So remember in the direct method, we start with the net income.
没付。
Okay, we start actually with profit before taxes, but the only item that we have here from income statement is net income. So this is our starting point. We add non-monetary items. Look very carefully here. What are the non-monetary items? Because we don't have full financial statements, but very selected information, it should be very easy to distinguish which information over there is non-monetary. And then plus or minus, it depends, the changes in working capital items. Again, this is simple because the 3 items over here that are taken from the balance sheet or from the statement of financial position, all of them are working capital items. This means this exercise is simple because it doesn't give you full financial statements and you are confused what to take, what to leave behind or not. All you need is just there. All you don't need is not there at all to make you confused. That's why it should be easy. So go on now.
Okay.
1 more minute, maybe. Did anybody finish? Good. I think that you completed line 1. Okay? So net income 30 million, you could do that, I guess. Good. Non-monetary items, did you identify any?
Depreciation.
7
Any other thing from depreciation? No, there is.
only
That is only
depreciation.
that.
Yes.
How much is the depreciation?
7 million.
Okay. Should we add it back or
Yes.
should we plus?
Yes.
Are you sure?
Yes.
Yes.
Okay, good. So, nothing else there. Plus or minus changes in working capital items. Now, here it is where I think most of you have stopped. Good. This is a little bit difficult. Now, we have the first change that we need to take into account is the accounts receivable from 15 million to 30. They have been increased with 15 million. Does that mean more money or less money to us in the indirect
Less
method?
money.
Okay, again, this is very helpful what we wrote over here. It becomes handy in this moment. So I'm just copying and pasting the rules. You are free to consult them every time you need until the exam, not during the exam, of course. So every time you have an increase in a current operating asset, such as trade receivables are, you have to deduct them. So minus increase in trade receivable. Okay, maybe. The second one, the inventory. We have a decrease in inventory with 3 million. What do you think should be here?
We had plus.
Plus.
Okay. Well, beyond these rules that we are mentioning over here, also you can try to analyze each time. If we have a decrease in inventory, this means that most probably I have sold this inventory, I have received money. That is why we have a plus sign over there. The decrease is with the effect of 3 million. Now, remember that the change here does not necessarily comply with the sign of the impact in the indirect method. So don't be confused with that. What I'm trying to say is, you see that the accounts receivable have been increased. Here it's a positive amount. But here you consider that with a minus as a negative amount. So please just do not put the amounts over there without thinking what they cause, what effect they bring. Or for example, inventory. We have a reduction in inventory. A reduction will be shown with a minus, but the impact that it has in the indirect method, the reduction of a operating asset means that I have more money, so it will be with a plus sign over here. Double think every time. Do not just take the amounts and put there without thinking. For example, the accounts payable, they have been increased from one year to the other. So I think if I have an increase in a liability, that means that I've kept the money in the company, and that has a positive impact for the cash position of the company. So plus increase in liability, accounts payable. Remember, trade receivable, account receivable are the same thing. Trade payable, account payable, again, are the same thing. So 10 million over here. Now you can be able to calculate the CFO. 30 plus 7, 40, 50, 35, I think. Sorry. Total effects we are required, and that is my mistake. The total effects are 7 plus 3 plus 10 plus 15. So the total effects is plus 5. Alternative A over here, right? Whereas if you are required to calculate the cash flows from operating activities, how much would that be? 30 plus 5, it would be 35 millions. Okay, but again, the question is not calculate the cash flows from operating, but calculate the total adjustments. So we are required only for the net effect of everything together. Okay, that's why the total effects are plus 5. 7 less 15 plus 3 plus 10. Together we should make plus 5. This is the total effect of adjustments only. If the total effect of adjustment is plus 5, that means that if you start from a net income equal to 30 million and you add as total adjustments 5 million, the cash flow from operations should be 35 million. Can you recognize the difference between the total adjustments and the cash flows from operations? Okay. Can we have a look at the illustration 8 right now? We have been provided with several pieces of information over here. I would say that might look complicated at first, but it is a very consistent and chronological information to prepare a statement of cash flows. It may seem difficult to do, to prepare a statement of cash flows, but the information here is so easy to handle. You'll see it's not difficult to prepare the cash flow statement for this case. So we have the net income, we have the accounts receivable, we have the inventories, we have the accounts payable, we have depreciation, we have how much we have sold the piece of land, how much did we pay to purchase a truck, how much we borrowed, and how much are the dividends. We have the beginning cash balance and ending cash balance as well. Based on this information, prepare a cash flow statement.
Net income.
In order to help you, maybe you are writing in the notebooks, that's fine. In order to help you, I'm just inserting a table in which we can prepare To prepare the cash flow statement, I'm starting with the first section, cash flows from operations. It is very obvious that what I can use here, the only method is the indirect method. The other one I cannot use for the moment. So we start with the net income, and first we apply the adjustments for non-monetary items. I'm leaving that to you to identify 1, 2, or 3. And then we apply the second kind of adjustment, which is working capital items. And actually, working capital items are 3 of them. Trade receivables, inventory, and payables. Probably after you have done that, you can be able to calculate the cash flows from operations. We continue with the cash flows from investing activities. 1 or 2 items over there, not more. And then with cash flows from financing, 1 or 2 items even there. Net cash flows. That again should be equal with a change between opening and closing cash balance. Opening balance of cash and closing balance of cash. So this is basically what you have to insert. All the information is over here. Just be careful to put in its rightful place. And another thing that might be easy for you, all the data is given in that order that you are going to use in the cash flow statement. It's not that some of the information is in the beginning and some in the end. Just follow reading and then put that in the line that it belongs. It's fairly easy, promise. For example, net income. Net income is over here. It's 5,000. Good. Adjustment for non-monetary item. Depreciation. Depreciation is over here. 8,000. We have to add it back. Then we work with the trade receivables and so on, but you can continue.
是。
Okay, so decreasing trade receivables by 2,000 would have a positive or a negative effect. The decrease in trade receivables would be a positive effect because that means money is coming in from our customers, good. Increasing inventory 4,000, that means that we are paying to buy more inventory, so minus 4,000. And decreasing payables, that is
Minus.
a minus again because
we
we
pay.
use our money to pay the liabilities, good. So the cash flows from operations is 5,000, which is the net income, plus 8,000 the depreciation, 13, plus 12, 15, less 11. So the cash flows from operations should be equal with, should be equal with 4,000. If we make all the pluses and minuses over here, this should be equal with 4,000, a positive cash flows from operations. Now we have to identify which of the transactions are investing, and that's fairly easy as well. During the year, we sold a piece of land. We sold with the same value that its book value was, 8,000. That means that we have no loss or gain to consider as a non-monetary item, but also that means that when we sell this piece of land, we are receiving exactly $8,000 in exchange for that. So proceeds from sale of land are $8,000. Again, read very carefully what it says over here. A piece of land was sold, and it was sold with the same market value as the book value. That means we have no loss, no gain. And that's why we didn't include any loss or gain over here and the non-monetary items. Okay? Another thing to consider here is that we purchased a new truck for $14,000. And we put that there, purchase of new truck. Be careful, it is a purchase, therefore it is with a minus 14,000. No more investing activities, only these two transactions. So we are done with that. That means that the cash flows from investing, it will be like minus 6,000. This is the cash flows from investing activities. What about the cash flows from financing? Now we have everything here again. The company borrowed a 2-year note from the bank. Now these $18,000 are coming in the company, and that means a positive cash inflow to be included under the final section. So borrowings, 2-year note. That is 18,000, positive sign, cash inflow coming in from new borrowings. Good? Then, dividends were paid in cash. Remember that dividends paid usually are part of the financing activities. So, dividends with a minus sign, be aware of that. Good. Now, use this carefully. Preferred stock was issued to retire $7,000 of long-term notes payable. Now, both of preferred stock and long-term notes payable, they both are part of the, let's say, financing activity, but I just substituted one for the other. I neither received cash nor paid cash, we just substituted one item for the other. So in the perspective of the cash flow statement, this means that we have no cash inflow nor cash outflow. So preferred stock issued to retire or to replace or to substitute another item, I'm putting that in red to make it known that this does not go through the cash flow statement at all. Why not? No money is coming in and no money is going out. We are just replacing one item with the other, okay? So no place to be shown in the cash flow statements. Good, we also have the beginning cash balance and the ending one. So beginning or opening is 10,000, closing is 20,000. I'm just putting that there. Cash flows from operating activities, they would be like 12,000 positive amount. And how much would be the net cash flows? Remember, it is the sum between cash flows from operations 4,000 positive minus 6,000 plus 12,000 positive. This is the net cash flows, the total sum of the cash flow statement, the sum of the three sections: cash flows from operations, cash flow from investing, and cash flow from financing. Over here, it's 10,000. You can easily see that it matches the difference between opening and closing balance in cash. Okay? From 10, this means that we have an increase in the balance of cash from 10,000 in the beginning to 20,000 at the end. You can see that the preparation of the cash flow statement can be as easy as this exercise. So it's not always very difficult like the exercises that we introduced this morning. It can be even easier like this one that we covered over here. Okay. Illustration 10 and 11 we'll see next week during the tutorial on Monday. But for the remaining minutes that we have here, I would like you, I know that you are tired, but trust me, this is important. You remember when I told you that usually IS 7 requires to reconcile the indirect method with the direct method? This is it. In this exercise, we need to convert an indirect method cash flow statement to the direct method. What we basically have is the performance statement and the statement of cash flows for year 1 and year 2. Now for year 1, you can see that the upper part represents the income statement very summarized. You know, very few items. It's not a very long one, and that's good. The income statement only has the items of sales, cost of goods sold, sales and general and administrative expenditure over here, interest expenses, and then we have the net income. Now, for the first year, we have used which method to prepare the cash flow statement? Is this the direct method or the indirect method?
Direct method.
We have used the direct method for the first year. Okay. Now the second year. The income statement is the same, with the same items. Sales, cost of sales, general selling expenses, interest expenses. Whereas the preparation of the cash flow statement follows what method in the second year?
Indirect.
We start with the net income, we have depreciation, and then we consider the changes in the working capital items. This seems like the indirect method to me. So what basically is required from you is to convert the cash flow statement of year 2022 in the direct method. Now, with one assumption, all the depreciation that is mentioned here, you can include that as part of the selling, general and administrative expenses. Okay? Good. I'm, as usual, preparing the way how you can solve this exercise, and you can fill the blanks yourself or together later. Now, in order to prepare the cash flow statement under the direct method, basically I need to calculate 4 or 5 items, it depends. First of all, I need to calculate cash receipts from customers, okay? And how can I do that? Remember the formula that we mentioned during the lecture? Cash receipts from customers are equal with revenues plus receivables opening balance less closing and you can calculate it for yourself. The second line that you need to calculate here, you need to convert revenue to cash receipts. Cost of goods sold, payments to suppliers. Well, you have the formula in your notes, just put it there. 1 or 2 minutes for you to make you think, and then we solve this exercise together, okay? The other item would probably be paid, selling, general, and administrative expenses. And the last item would be interest paid. How did we know that? Of course, in the direct method, we take each of these items in the income statement and we convert that into a cash flow, as we said, using the formula. Remember that when we calculate at the end the cash flows from operations, it should be equal to that provided or calculated through the indirect method. So again, when you finish all the calculations over there, the cash flow should be equal to 1,195, the same amount as here. So you have a way to check for your calculations, okay? I'm providing the formulas just to help you through the way. I'm sorry, now I read that the depreciation is part of the general expenditure, so it's not part of the cost of goods sold. Apologize. I just read this. Okay. Regarding the paid, selling, general administrative expenditure, that would be selling, general administrative expenses less depreciation. Remember that as depreciation is part of this category, this means that I'm not paying them, that are not monetary expenditure minus depreciation. That is the only calculation you need to do there. And for the interest paid, let me see. Okay, we have an interest payable over here at the indirect method. So probably you need to take into account the formula that we introduced this morning. Interest paid would be equal to interest expenses plus interest payable opening balance less closing balance of interest payable. So these are basically the formula. If you properly follow them, there should be no problem at calculating the cash flows from operations with the direct method. Only 1 minute for you to think, and then we go through that together. Which one of you could calculate the cash receipts from customers? Maybe can tell me how much did you calculate them and put there? What do you think?
We need to 12,000.
Sorry?
We have to
Uh-huh.
pay 12,000 minus 240.
Why minus 140?
Because 240 is the change in trade receivable from the beginning of the opening balance and the end balance.
Okay, Gloria, I agree with you. Now, sorry. Okay. This is the effects of masks. I apologize for that. What is your name, please?
Alicia.
Alicia. You have the name of my daughter. Okay, Alicia, I will not forget that. Very good. Now, to help you all with the calculations, you here have the second type of adjustments in the indirect method that you need to take into account to properly think about the signs over here. Be careful. Even though, as your friend said, in this case, I will consider the trade receivables with a minus, exactly as it is here. That does not mean that it will be the same exact situation for the other items. So please have into account everything that is suggested in the indirect method. And whenever you are now deciding, have a look to these pluses and minuses. For example, when we come at the revenue, it is very easy. Someone will say, okay, but you know what? We don't have the opening and closing balances of receivables. What we actually have here, it is the effect, not the change. Be careful about that. This minus 240, it is not decrease or increase. It is the effect, the impact, according to the indirect method. And to think about that, we have a negative impact whenever we have an increase in assets. So actually this minus 240, even though it is with a minus, it is an increase in assets, okay? Now, if it is an increase in assets, this means that the closing balance will be higher than the opening balance. So we have increased the assets. That means the closing balance with a minus there will be higher than the opening balance, and therefore we deduct the value of 240. Okay, to make it more clear, that means that the sales are 12,000 over here, less 240. This will give us an amount of cash receipts from customers, 11,760. Okay? Again, how did we calculate that? We combine together the revenue and the related item from the statement of financial position. Well, of course, I don't have the opening and closing balances, but I can think about that. How can we evolve all this information and process this information? We see that the impact of trade receivables is with a minus. That means that we have an increase in trade receivables. That means that we have received less than we have sold. So 12,000 less 240, this is 11,760. Now, this should be a little bit more complicated, but not impossible. Again, at this point, I'm waiting from Alice and Gloria,
Seven.
or the others as well.
We
Mhm.
we had to add to 7,100.
Mhm.
We had to have 200 of
Yes.
inventories.
Mhm.
To have 240 for trade payables.
So you have added the inventory,
Yes.
Yes.
and you have added the trade payables?
Yes.
Yes, very well. Even though you find them there with a minus, don't be so short-sighted as to include them in the direct method with the same sign that they have in the indirect method. Sometimes the effect of transactions is the contrary in two different methods. Now, for the trade receivables, this was easy. In the indirect method, it was with a minus. Under the direct method as well with a minus. Whereas you see that inventories and trade payables, it's not the same. They are included or considered with a minus. They have a decreasing effect under the indirect method. But when I come to the direct method, I should add them, not deduct them. And why do we do that? The floor is again to you.
We do that because inventories increase during the year. So the difference between closing inventories and opening inventories is positive. And trade payables decrease during the year. So the difference between opening payables and closing payables is negative.
Very well, I agree with what you said. Did the others understood or got that? Okay, this is not easy, it is difficult. If it is not easy to prepare a cash flow statement, imagine how not easy it is to convert from indirect method to the direct method. That is like the maximum complication and sophistication of this kind of exercises that were done to you. So what we are saying here that inventories have a negative effect, okay? As we see in the indirect method. A negative effect of an asset comes every time we have an increase in the assets, right? As we see here in this scheme. Increasing an asset means that the closing inventory is bigger, is higher than the opening inventory. So this difference over here, it should be a positive one. So again, inventory has increased. This means that closing plus opening, it's a positive value, plus 200. The same thing we may say about the payables. We see that the trade payables have a negative effect. It doesn't say it has been increased or decreased. We should find that out. When do the payables have a negative effect? Even though if I don't consult the scheme over here, I may think about that. A payable has a negative impact whenever it has been paid back. That means that I'm paying some money more. Okay, so therefore we add 240 to the payments that we need to calculate. Very well. Now the rest is very, very simple, I may say. The paid selling, general, and other expenses should be taken into consideration without the depreciation. So that means that this expenditure over here, 3,700, includes the depreciation of 1,000. How much did I pay? So again, the expenditure includes depreciation. How much did I pay? The difference between expenditure and the part that I didn't actually pay. So here, 3,700 less 1,000, which is the depreciation, and the paid selling general and administrative expenditure is 2,700. Okay? And then interest paid, again we have to follow the general rule that we mentioned. The interest expenses is 300 over here, but remember, the interest payable over here has been decreased. When does that happen? When do we decrease or reduce the liability? Whenever we pay more. That means that except for the interest expenditure of the year 300, I've also paid 25 to reduce the balance of the accumulated liabilities. And therefore, 300 plus 25, this means that the interest paid is 325 over here. Look, I did again one of my common mistakes that I accept. Minus 2,700. Don't forget these minuses. Sometimes they are a big problem. Now, can we check if we are correct? 11,760 less 7,540 less 2,700 less 325. If you try that, you will find that the cash flows from operations is actually 1,195. Okay? Good. This exercise is not easy, I accept that, but this does not mean that I will ask you the same thing in the exam to convert a full statement from one method to the other. But still you may have multiple choice question of the type. The inventory has been increased by this amount. What is the effect in the indirect method? Or what is the effect in the direct method? So please be prepared to think about specific transactions, okay? Okay. Congratulations that you survived day 2 with cash flow statement. Now you are strong enough to continue the rest. We see tomorrow for the last day of lecture for this week. I know it has been very intense, every day something new, but you are really good students, I can see that. See you tomorrow then, and goodbye.
Thank you, bye.